Hey everyone, and thanks for jumping back into the macroverse. Today, we're going to talk about the most recent jobs report, and we're going to be looking at job openings. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. Let's go ahead and jump in. So, about every month or so, we try to provide an update on the labor market, normally a couple of times a month, I suppose. But we did get a recent jobs report yesterday where we actually saw total job openings or total non-farm job openings drop by approximately 338,000. And while 338,000 might sound like a lot, it's actually a lot more than what we would have previously assumed because last month, I believe total non-farm job openings were about at 9.58 million, but that number was actually revised down a lot. And so it's more so we're down 338,000 from that revision, not from the initial number that we were given. So with that said, now that we have the revised data and we have a new data point, which of course could get revised as well next month, we can see that total non-farm job openings are coming down somewhat quickly. Now, the reason we follow this is because, of course, we are in a tightening cycle by the Federal Reserve where they are aggressively raising interest rates, or at least they have been aggressively raising interest rates, and they've been rolling off assets from their balance sheet, going through quantitative tightening, or QT. And of course, going through something like this is bound to have an effect on the economy. And you can see that in March of 2022, we can see that total job openings peaked, which is again right around the time that the Fed started raising interest rates. Now, ever since then, total non-farm job openings have decreased from around 12.03 million to around 8.83 million. So there has been something achieved here in loosening up the labor market. It's not as tight as it once was. There used to be a ton of job openings, and there still are a lot, but it is at least coming down, which of course is what the Fed wants to see. Now, one of the reasons that I've said that there was no recession in 2022, and at least up to this point, there has not been a recession in 2023, is just because of how much excess there has been sort of get rid of. If you look at job openings back in the financial crisis, the peak was, below 5 million. And, it sort of bottomed out over here at around, just above 2 million or so. But again, from these heights, it wasn't nearly as high. It was actually lower, you can see, from where it was back over in the dot-com era. So this number up here, 12 million, we've seen job openings go down by more than 3 million for total non-farm, but there was just so many open to begin with that it's taken us this long, arguably, just to get back to the prior trend. So the issue, of course, is if the Fed continues to raise rates and or hold them at high levels, which is probably what they're going to do, at least hold them at high levels. We don't know yet if they're going to raise again or not, but there is at least there has been a growing probability of that happening as well. The issue, of course, is if they remain hawkish for too long, they could push the U.S. economy into a recession. But when you look at charts like this, you can kind of understand why there hasn't really been a recession yet. It's because there's just been so much excess. So you could sort of draw an imaginary trend line through here and see that all that has been accomplished so far is that we've just gotten back to trend. So then the expectation or where we might have to start to figure out exactly how determined the Fed is by the end of this year and early 2024, that's where we'll finally get a glimpse as to just how hawkish the Fed is willing to be. How far are they willing to go to get inflation out? My guess is they're going to, as Powell says, they're going to stay at it. They're going to stay the course until the job is done. So far, it's been relatively simple because inflation has been high. And so their mandate, of course, forces them, they need to achieve price stability. And with inflation high, they have to raise rates. They have to go through QT. At this point, the labor market, their other mandate, maximum employment, has not really been an issue because the unemployment rate is still at historical lows. As job openings come down, though, the unemployment rate could start to have a lagged effect by the end of this year, early next year, where it might start to finally tick up some. But again, by looking at charts like this, we can better understand why the U.S. economy has not been in a recession in 2022 and why it hasn't been in a recession in 2023 is because so much of the effects that these rates have more or less just gotten total non-farm job openings just back to the prior trend. Okay. And if you were to look at, say, a year-over-year percentage change, normally when you would look at this, it would in fact be recessionary. And of course, if we stay down here, eventually it would become recessionary, right? It's not just going down to these levels, but it's also spending considerable amount of time where job openings are being, sort of removed from the economy. And the reason why that's a thing is because there are people that are getting laid off. There have just been so many job openings for them to sort of theoretically go find a new job. But as job openings disappear, then it's going to be harder and harder for people to find more jobs if they do get laid off, and that's where a recession could theoretically kick in. But I mean, again, it might not become an issue until next year, for all we know. It could be later this year, it could be early next year. I don't really know, but that at least does provide some visualization as to why the labor market has been resilient. If you look at total private job openings, you can see that it's also been coming down. It topped out here in March at around 11.01 million, and now it's down to about 7.87 million. So it is dropping relatively quickly. We can look at total government. Now, government jobs have actually been one of the main reasons that it's been so far elevated. You can see the government jobs haven't really skipped a beat here, but this most recent print, we would drop from around 1.12 million all the way down to 962,000, which is a pretty big drop. And it's, looks to be like the second lowest print. You can see October 2022 was lower, but it looks to be the second lowest print, basically since 2021 perhaps. So that, of course, is having an effect. You can look at state and local, which is very similar to what we saw with government. Construction is still relatively stagnant. It hasn't made a huge move. It is rolling over slightly again, but it is still, at fairly elevated levels, all things considered, and still arguably above trend. Again, going back to total non-farm or total private, it sort of looks like we're just now getting back to trend. If you look at something like construction, it would still seem to reason that we're still above trend. And so there's still, more wiggle room in that sector than there might be in some other ones. Manufacturing, though, is getting somewhat testy here because it's arguably back to the prior trend as well. And again, the issue is if it just were to stop here and slowly start trending back up, then that could be akin to, say, a soft landing. The issue is that interest rate, hikes and QT, all this stuff, that is a lag effect. It's long and variable lags. And so we don't really know how long it takes for all of these interest rates to fully hit the economy. And if the last several interest rates that have been carried out have not hit the economy yet, then it stands to reason that this number could continue to drop lower and then theoretically go well below the prior trend, which is where it could obviously become an issue. And you can kind of see how we're still sort of on the prior trend. But you get, 3 or 4 more prints, get us to the end of the year, early next year. You could start to sort of imagine how it might become a little bit more glaringly obvious that it's starting to go below trend. But at this point, still theoretically right on trend. Durable goods, job openings, still coming down. That one is still arguably above trend. And you can see that it dropped by around 15,000. Looking at things like month over month percentage change, you can see that it's been negative, right? Negative 10% here, negative 0.649%, negative 8%, negative 6, negative 4, negative 4, negative 4, right? So you keep getting these negative 4%, right? Eventually it's going to have an effect. It's just, again, there's been so much excess that it's just taking a long time for it to be removed. If you're to look at things like non-durable goods, you can see that that's actually been coming down a lot faster. And arguably that one is theoretically already below trend. It's down to 202,000 and it topped out back in April of 2021 or May of 2021 at 400,000. So it's sort of been approximately cut in half for non-durable goods manufacturing job openings. So look at trade, transportation, and utilities. We can see that it has been slowly trending down, but this most recent month, we actually saw it go up by about 43,000 job openings. Retail trade has mostly been flat. You can see it was actually perfectly flat from the last month. Continuing on to professional and business services, that one actually had a pretty large drop off here over the last month. I mean, it's down to about 198,000, so it's down to 1.34 million. Last month, it was actually around 1.53 million. The month before that, it was at 1.7 million. So if you were to look at, say, a month-over-month percentage change on professional and business services, it's actually down to around negative 12.91%. Last month, it was at negative 9.5%. And the month before that, it was at negative 1.34%. So it actually has been somewhat accelerating recently. So that is at least something to consider. So if you go back to the normal trend, you can argue that that one is starting to potentially go below trend. And if we get a few more months where it's continuing this decrease, then I think it would be fair to say it's well below trend and potentially entering into a recessionary type environment. Education and health services job openings has ticked down slightly by about 110,000 job openings. Note that the peak though was all the way up here at well over, at over 2.25 million job openings, 2.28 million. So it still has theoretically a long way to go, still some excess there to remove. And if you're looking at healthcare and social assistance, still still a long way to go for that one. Leisure and hospitality, that one has dropped, but this last month it actually went back up by about 62,000 jobs. Art, entertainment, and recreation went slightly up, and accommodation and food services went slightly up. But, one of the main ones that I think a lot of people are interested in, total non-farm, seems to get one of the, the sort of the largest headlines, again, at just sort of encapsulating a lot of different things, right? 8.83 million. And down 338,000 from the revised number. Remember, we're referencing the revised number. From the actual number, it's down, I think maybe, I don't remember exactly what it was. I think it was at like 9.58 million last time. So let's just call it 9.6 million. And now it's down to about 8.9. So it might even be down 600,000 job openings from the prior print. It's just that the prior print was revised, and therefore, now it's only, quote unquote, only down 338,000 from what the revised print was. But if the prior print had not been revised, it would be down approximately, I think, by about 600,000 job openings. But again, you can see that the Fed is more or less getting what they want. We are seeing inflation go down. We are seeing job openings go down. We're seeing the loosening, the softening of labor market conditions. The issue is not can they accomplish this. The issue is can they accomplish it without getting a hard landing. And again, history shows that hard landings are often a likely outcome especially for aggressive Fed tightening cycles. And this is arguably one of the most aggressive, if not the most aggressive. And so I think we still need to be following this stuff to see if it does slow down or if this stuff continues to accelerate. Because if job openings continue to accelerate to the downside, then it means as these other companies lay people off, those people that get laid off don't have the same, potential to find other jobs if a lot of these other companies are no longer hiring. And that's where you can see the unemployment rate start to move higher. But hopefully this video is useful to you. I know these are not the most riveting, but I do think it's important to follow the labor market because we know that the stock market will respond whenever the unemployment rate starts to sort of slowly move up. And it'll probably lead it, actually. It'll probably go down before the unemployment rate starts to go up. Anyways, if you guys like the content, make sure you subscribe to the channel, give the video a thumbs up. And again, check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. I'll see you next time. Bye.